Hey guys, welcome back to Trading with Jen. Okay, so this particular video, I'd like to speak on five biggest mistakes that every beginner trader actually makes. And this is just so underestimated, under talked about that everybody just kind of thinks coming into this game is just learning something overnight and then you get the strategy. But it's not. It's actually a lot more than that. It's a lot more than just the skill set. In fact, the skill set is only approximately 10% of trading because the rest of it is essentially psychological, emotional, just having that discipline. But let's go ahead and talk about that. So, first one up would have to be trading without a plan. Trading without a plan, you are practically gambling. When people say, oh, Forex is a scam, trading is a scam, listen, it's going to feel like a scam if you don't have a plan into place. At this moment, you're not even trading, with defined entries, exit, you're trading with emotions, which is something that we have to kind of leave to the side when it comes to trading. So, yeah, trading without a plan happens to be the first mistake that every beginner trader does. Secondly, I would have to say it would have to be risk management. Basically, risking anything more than 1 to 3% is just not ideal. Typically to be on the safer side, to be a little bit more conservative into your trades, I would say 1 to 2% would have to be the risk management of whatever your capital size is. For instance, let's say if you were on a prop firm, just hypothetically speaking, you're running a or going for a $100,000 account prop firm, you would have to not risk anything more than 3%. Ideally, like I said, 1 to 2%, that's risking about $1,000 to $2,000 out of that 100,000, right? So depending on what your capital is, 2% is like it. Okay, 3% is pushing it, even though it is still on the conservative side. I would say 1 to 2%. So ignoring proper risk management has to be the number two, top two mistakes of every beginner trader. Um, Third, I would have to say over trading. Over trading can look like, you know, um, FOMOing into a trade, right? Fear of missing out. You already made some profit, but for whatever reason, you see this breakout, you see this opportunity where you feel like you've cut your profits too short and you're just jumping in there, right? Uncontrollably. That is emotionally trading. You should be chasing a setup and not the money. Money will come once you have that consistency in being able to follow the setup and follow the rules that you should have had in place to begin with. Um, Boredom is also part of emotional trading or over trading. When you feel like, you're just getting into a trade just to get into a trade to see if you're making profits or not, that's actually very toxic when it comes to this industry. Also, revenge trading. Revenge trading is definitely emotionally trading. When you've Revenge trading is when you take a loss and all of a sudden you feel like you got to make it back, right? Revenge trading, whether you're trading conservatively or not, it can actually go bad because instead of like breaking even at some point or perhaps taking a small loss, now you're chasing into something that it's almost kind of like a known because you're emotionally trading, right? You want to make that money back or you feel like you could have made a little bit more, which kind of dabbles into fear of missing out, FOMO. All of that is very tangible when it comes to, emotionally trading or over trading, all in all. Number four, I would have to say position trading. Um, Not in terms of, holding positions for a really long time, but just I want to say position sizing, I should have said. Um, Putting a bigger position than what you should have. I guess it falls under risk management, but definitely misusing your leverage. Different brokers, different leverages, obviously, we got 1 to 100, 1 to 500, 1 to 200. You guys should be able to get familiarized with that prior to putting a particular trade in. Um, Excessive position trading kind of falls under this as well, meaning that you're pretty much dollar cost averaging into positions when you are in a losing position, which is something we should never do. Aside from that one losing trade, let's just say that you did have one open already, and then you just add on more to that, thinking that, it's gonna come right back. Well, it can, right? To those particular positions. But the question is, how much longer is it going to take until it comes back to your initial position, right? Are you using time frame analysis where you were scalping when you put those positions in, but you were, mentally basing it off a higher time frame opposed to a smaller time frame? Remember, scalping is more on a shorter time frame where you're analyzing things that happens to be a lot more quicker. Anything that happens on a higher time frame is going to take a longer period of time. So dollar cost averaging or just kind of having that excessive position size on a smaller time frame with the mental thought of, okay, this is going to turn back around on a higher time frame. Just be prepared for that drawdown. Again, this is why risk management is highly, highly important. Okay, so that kind of falls under risk management, but I wanted to just say that over position and sizing does affect your trading account, and also over leveraging and not really getting familiar with the leverage. Number five, I want to say the fifth one would have to be lacking patience. Just basically chasing the move or chasing the trend. Again, depending on the time frame that you're using, you want to be able to kind of align it with your capital size, right? If you're running a smaller account and you're chasing bigger trends, um, it wouldn't be ideal because, depending on how much you're risking, your account may not be able to take that pullback on that particular trend. Not to say that it's not possible, right? It also depends on the pairs that you're trading. Obviously, if you're trading like Forex pairs and you're doing 1 to 3% risk, it could definitely would hold it versus if you were to, swing those trends on a higher time frame on like indices or commodities where margin does take up a little bit more over currency pairs. So that is something that a lot of beginners make a mistake on because they underestimate forex versus, commodities like gold, silver, or perhaps indices such as the Nasdaq or, US 30. All of that makes a huge difference. So I would have to say lacking patience on some pairs and obviously chasing trends depending on the pairs that you're having. Right? You just want to make sure you have enough in your capital in order to be able to withstand or withhold those drawdowns on, chasing those trends on a higher time frame. If you're on a smaller time frame, I would say you're totally fine. And then again, always use that proper risk management, 1 to 3% of your capital size. Yeah. Yeah, I think I covered the last, top five mistakes that every beginner trader makes. Um, so reevaluate exactly where is it that you're starting from, and then just kind of pinpoint those things out that I mentioned and kind of redefine it and put an edge to it. But other than that, guys, that is the top five mistakes for beginner traders into a nutshell. If you guys enjoyed the video, please don't forget to like and subscribe for more. Thank you. Bye.